So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to the Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to the Daily Call. Today we're going to answer the question, what is an arbitrage opportunity? So an arbitrage opportunity is nothing more than a transaction or a series of transactions in which you generate a profit without taking any risk. And so they are far and few between because many arbitrage opportunities get found very quickly, and then the trading edge or the arbitrage edge starts to disappear as more and more people start to flood the market. But to give you an example of this, and I think that there is still potentially an opportunity to do this in small cases during expiration week, in particular during expiration day, to generate a profit through an arbitrage type trade following some inverted positions. So again, this doesn't mean necessarily that you take zero risk, but probably as close to zero risk as you could potentially make with a trade. So here's an opportunity, and I've mentioned this before on Facebook Live. I don't know how often it shows up, but I've seen it a couple times now on particular stocks. They're usually a little bit lightly traded stocks with not a lot of activity and volume, and definitely something I want to explore further as our new auto trading platform rolls out. I want to have an arbitrage trading strategy kind of around this concept. But let's say that you're at expiration day and we're literally the last 10 to 15 minutes before the market closes on the last day that contracts can be traded for a week or a month or whatever expiration day you're on. So you are at the end of the day and it's about time for the option contracts to cease being traded. And during that time period, what I've seen before is, let's say a stock is trading at $50 on expiration day, right before the markets close and trading stops for the day. You can effectively sell a 51 strike put option. So sell a put option that's $1 higher than where the stock is going to close, around say $50. And then you can sell the 49 call options, which are $1 lower than where the stock is going to close, for $2.02. And so by selling this inverted strangle for just 10 minutes or 15 minutes right before the market closes, you basically get to collect a premium that is worth more than what it will actually settle at and net out at with the exercise and assignment of the shares. So in this case, it's a $2 wide inverted strangle, which means that it will settle an exercise for $2, which is the width of the inversion. So if you're able to collect anything more than that, say $2.02, and at expiration, everything settles and nets out as a $2 debit on the position, then what effectively happens is you get to keep a 2-cent profit for your trade. Now, in my opinion, this is about as close to an arbitrage opportunity that many traders are going to come to, because you have exposure for 10 minutes or 15 minutes. And again, it's on a stock that probably is not moving that much, that has low volume and open interest. And so the pricing disparities are wide enough that you can maybe squeeze a couple contracts in here. Now, the downside to this obviously is that any arbitrage opportunity where you have money at risk for longer than, a couple seconds starts to increase the potential drawbacks to that strategy. So we try to enter this probably as close to the end of the day as possible, the last minute or 2 minutes or even 5 minutes of the trading day. And then obviously many arbitrage opportunities you can't scale. So if it's a low float, low liquidity type ETF or stock position that has this opportunity, you probably are not going to be able to, get $1 million worth of trades executed, right? There's probably just a very few contracts that you can go after. But this is a great example of, potentially something that's happening right now in the market all over the place. If you can find these, where these little, kind of penny profits all over the place can be scalped with very little to almost no risk in some cases if you execute them right at the end of the day. And I think it's a really interesting concept. Now, again, this only works if, for example, you already have factored in commissions, or maybe you're trading on somebody like Robinhood, which doesn't have exercise and assignment fees or any commissions for executing this, so that you can actually get that full 2-cent profit off of this thing. And it's not that much. I mean, it's not a lot by any stretch, but again, it's an example of an arbitrage opportunity. So hopefully this helps out. Hopefully it wasn't too complex, but again, an arbitrage opportunity is just simply any transaction or series of transactions that you can make to generate a profit with little to no risk. And so hopefully that helps out. As always, if you have any questions, let me know. And until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.